Well, the comparison couldn't be more stark. While the bulk of the world's banks live in a state of high anxiety, grappling with all manner of problems on either side of the Atlantic, in Australia, the Big Four just keep producing record profits. This week, Westpac announced a solid 7% increase in cash earnings to $6.3 billion, falling just short of the Commonwealth's recently posted all-comers record of $6.6 billion. Even concerns about slow growth in lending eased a bit this week with the Reserve Bank's cut in official interest rates. I spoke to the Westpac CEO, Gail Kelly, about the dual-speed world of banking. Well, Gail Kelly, do you think this week's rate cut would have been necessary but for the crisis in Europe? That is to say, would it be justified by the state of the domestic economy?
Alan, it's really quite hard to separate the issues. There's no question that the issues that we're dealing with in Europe have had quite a profound effect around the world and are flowing through to softening confidence here and additional caution and concern here. So I do think there have been quite a significant factor leading to the rate drop that we've had here in this past week.
And you're seeing the need for further rate cuts, aren't you, in Australia?
I think we're going to need more than one. Clearly, let's wait and see how Europe travels over the next period, although there don't seem to be too many signs that things will settle too early, and the issues there are so complex and there's so much at stake, and I think we're in for a long haul as far as Europe is concerned. And I think what's going to happen will be that customers will take the extra cash that they've got and probably apply it more to debt repayment and to savings and still wait and see if overall sentiment improves. Having said that, terrific that we've had this rate reduction, because I think it will start to turn the dial a little bit more in the way of confidence setting.
But actually what you're pointing to is the fact that it won't have that much impact. I mean, in the sense that people won't reduce their repayments on their mortgages straight away, will they? I mean, they'll probably keep repaying the same amount, just get it off their principal.
Well, I think people will deploy whatever additional cash that they've got, either to save or indeed to repay further debt. So I think that's what's going to happen, rather than go and spend more. Because ultimately, obviously, what we need for the economy to grow is for people and businesses to regain confidence and to decide now's the time to spend more and indeed to invest more. But I think we're a little bit off from that at this point.
In fact, your results showed this week that people are rushing to put the money into the bank. You've got $11 billion more in deposits in the past 12 months than you've been able to lend, which is a bit of a problem for you, isn't it?
Well, I don't know. In this kind of environment, we were very, very happy to be able to attract the savings. Very important in terms of the overall strength of our balance sheet. And right now, in very difficult, troubled times, I think there's probably nothing more important than having a very strong balance sheet. So it goes with the times.
Yes, but is there a problem? I mean, in order to grow profits, you have to lend, don't you? I mean, you need to, and you've got very flat lending growth at the moment.
Well, there are a variety of things that actually support our overall profit growth. We look at core earnings as probably the strongest indicator, and I was really pleased to see in this last result a very strong core earnings growth in our major line divisions. We saw that particularly in our Westpac RBB business, our Westpac New Zealand business, and indeed in wealth, which I think is a standout for the Westpac group. So strong core earnings in the sort of 10, 9, 7% ranges for those three businesses. St George too, coming up from a slower start. So it's more than lending. It's to do with the margin management. It's also to do with the cross-sell activities and deepening relationships with customers. And that's been a very important element of our strategy.
What is the lending book at the moment telling you about the economy? I mean, business lending was quite flat. In fact, I think it went backwards. Home lending is reasonably strong. But what are the nuances within that, the messages you're getting from about the economy?
That it's slow, that customers are cautious, that they're preferring to sit on their hands at the moment, that they're preferring to save, they're preferring to pay debt. A number of consumers and businesses found themselves with far too high gearing levels through the midst of the global financial crisis. Don't want to find themselves in that position again. So I don't think it's a bad thing. It's meant that we don't have further asset bubbles. And property prices, while they've softened a little, they certainly haven't fallen.
But it does mean that you have to watch your costs and in fact get your costs down. And now you're talking about more offshoring, aren't you? Can you quantify that to some extent?
I think what it means is in this new environment, banking has to be run differently. We're in an environment where capital is going to be a lot higher. Before the global financial crisis, our capital was around 7% Tier 1 ratio. We're now coming up closer to 10. Our funding, we need to pay a lot more attention to that and have much stronger levels of liquidity. So our liquid assets are over 100 billion. And again, prior to the global financial crisis, were at about 20 billion. Getting used to an environment where lending growth will be lower. Now, it's particularly low this past year. I think it'll go up from there, but I don't think it'll get back to the kinds of levels that we saw before the global financial crisis. And so in a new world, it's important for us to restructure our businesses to actually be appropriately positioned for this new world.
So are you saying that most of your profit growth for a while to come will come from cost reduction?
No, it's a mix. There's no question it's a mix. Our whole strategy is about depth of customer relationships. So with our multi-brand, we're able to appeal to more customers into our group. Customers who prefer a regional bank or a major bank, we can appeal to both types of customers. And then we apply the model of growing depth of relationship, more in the way of wealth and superannuation and insurance and transactional banking, payments, all of those elements. And that actually absolutely supports stronger revenue growth. On the cost side, clearly we want to be as efficient as we can, simplify, streamline, make it easier for our customers. And in our case, we've got plenty of upside there because we've still got a scenario where we've got a St. George system and a Westpac system and indeed a RAM system. So over time, we'll be moving towards one common operating system, common set of processes, common set of practices, and that'll improve outcomes for customers, but certainly drive cost efficiencies for us as well.
So the upside, the opportunity that you're talking about comes from the fact that you're inefficient now.
No, look, we've just been through a very big merger. I mean, that would be the truth. And also, when times are going to be a bit tougher, you become a bit more finely tuned about how to, in fact, truly streamline, standardize, simplify. And we're at that point right now.
What do you think the future is for Europe's banks?
Gosh, it's tough. I mean, clearly, we're in for a scenario where significant capitalization is going to be required. And the problem there is the authorities, the regulators are calling for that capitalization in quite a speedy time frame.
But they're not going to be able to raise that money, are they?
Well, that's part of the issue. And the other thing is what banks will do, rather than go out to raise money, is what they'll do is to try and deleverage. And of course, that has a compounding effect.
Well, they'll cut back on their lending, you mean?
Well, that's correct, and it will contract the economy growth within Europe. So I think the regulators are going to have to, together with politicians, just think about how much capital and in what time frame in order to not have undue impact, further contractory impact on the economy. Do
you think, in fact, the authorities in Europe should go easy on the capitalisation rules and let them off for a while?
Well, it's not about letting them off. We all know that we need to get to a scenario where banks are stronger from a capital point of view and are more stable and have stronger liquidity as well. So we all know we need to move in that direction. But bearing in mind the overlay of the very significant depressed economic conditions there and the sovereign debt related issues there, I think there may be a case to be made simply to say, think about the quantum and the timing with regard to this capital impost, because otherwise what banks will do is deleverage rather than actually raise capital.
And just looking ahead, in terms of your own views about the economy here, obviously Australia is sort of caught between China and Europe and America. How do you see the balance playing out? The European economy obviously under pressure, the sort of pressure you've been talking about. American economy likewise. China, on the other hand, continuing to grow. So how do you see that working for Australia?
Well, I'd have to say I'm really, really happy and pleased to be a banker living in Australia. I think our economy is fundamentally differently placed from Europe or the US, as you pointed to. We benefit from the strong resources sector that we have. We benefit from our proximity to Asia and the trade flows that we have with Asia and the geographic links that we have with Asia. And we also come from, before the crisis, we were in a strong position. And that's a huge help for us. The banking system was strong and our own government debt position was strong in the sense that we were in surplus. So we have the tools at play to help us manage a downturn. Cash rates, even after this 25 basis point reduction, is at 4.5. So we've got room to go if the Reserve Bank believe it necessary to be able to provide further support to the economy
and you
and to
believe
demand.
it is necessary, don't you?
I think there will be further requirement for reductions into next year. We also have a very low level of government debt, truly a very low level, and that means that there too there's ammunition, should it be required, to provide further stimulus into the economy. But what we grapple with here is we know that much overused term of multi-speed economy or dual-speed economy. So some sectors really doing it quite tough, and some of that's a function of this consumer caution that we've spoken about earlier. Some of it's a function of the high Australian dollar. So a high Australian dollar puts pressure on some of our manufacturing sector, and of course on tourism. So different sectors operating at different speeds, grappling with different issues, but the underlying diversification of the Australian economy does stand us in good stead.
Thanks for joining us, Gail Kelly.
Thank you very much, Alan.